Learning how to buy bonds is an important component of your investor education. A well-diversified investment portfolio should include a mix of equities and fixed income, allowing you to weather market turbulence while also capturing gains. But how do you go about purchasing bonds? This is Financial and Investment Wisdom, your key to financial independence. Before we go into the basics of buying bonds, be sure to subscribe and turn on the notifications so you don't miss a single video. Let's start with what to look for when purchasing bonds. Purchasing bonds can be a difficult task. This is especially relevant if you're purchasing secondhand bonds or not purchasing straight from the underwriter. Here are the important things to consider before buying a bond to ensure you're getting a decent deal. Credit scores. The most important thing to consider is whether or not the corporation can truly pay its bonds. Credit ratings from rating agencies such as Moody's, Standard & Poor's, and Fitch can help you find this out. The safest rating is AAA, which is given to Treasury bonds. Duration. A bond's duration, which Vanguard defines as a period expressed in years that indicates how long it will take an investor to recover the true price of a bond, taking into account the present value of its future interest payments and principal repayment, is an indicator of how sensitive the bond will be to interest rate changes. When interest rates change, a longer duration means more variability. The value of a bond decreases as interest rates rise. Hold on to your bond until its maturity date if you want to ensure that you get your specified interest rate and the full payout. Fees. If you aren't buying directly from the underwriter, you should always be aware of the costs that a brokerage can impose on the cost of a bond. Using publicly available data on the pricing of the bond you want to buy, or bonds with similar maturities, credit ratings, and interest rates, you can make sure you're getting a good bargain. Now let's look at how to buy individual bonds. Individual bonds can be purchased through a broker or directly from the issuing government agency. The opportunity for investors to lock in a specific yield for a set length of time is one of the most common reasons for purchasing individual bonds. The yield on a bond mutual fund or fixed income exchange traded fund, ETF, changes over time, whereas this technique provides stability. It's crucial to remember that individual bonds must be purchased in their entirety. Because most bonds are sold in $1,000 increments, you'll need to fund your brokerage account with at least that amount to get started. It's worth noting that, while the U.S. Treasury bonds have a $1,000 face value, they also have a $100 minimum bid and are offered in $100 increments. U.S. bonds can be bought through a broker or directly from Treasury Direct. The foundations of buying an individual bond remain the same whether you're looking into municipal bonds, corporate bonds, or treasuries. You can acquire them as new issues or on the secondary market. Let's discuss new issue bonds. Purchasing new issue bonds entails purchasing bonds on the primary market or the first time they are released, comparable to purchasing shares in a company's initial public offering, IPO. The offering price is the price at which new issue bonds are purchased by investors. So how can you buy new issues of corporate bonds? It can be difficult for ordinary investors to get new issue corporate bonds. A relationship with the bank or brokerage that manages the principal bond offering is usually required. When it comes to corporate bonds, you should know the bond's rating, such as the investment grade or non-investment grade / junk bonds, term, interest rate, whether fixed or floating, and how the coupon or interest payment is paid regularly or is zero coupon. To finalize your purchase, you'll need a brokerage account with enough funds to cover the purchase amount as well as any commissions your broker may impose. How to purchase municipal bonds as new issues now. Investing in municipal bonds as new issues necessitates participation in the issuer's retail order period. You'll need to open a brokerage account with the financial institution that backs the bond issue and submit a request detailing the quantity, coupon, and maturity date of the bonds you intend to buy. The bond prospectus, which is issued to prospective investors, lists the possible coupons and maturity dates. Also, how to purchase new issues of government bonds. You can buy government bonds such as U.S. government bonds. Bonds can be purchased through a broker or directly from Treasury Direct. Treasury bonds are issued in $100 increments as previously stated. Investors can purchase new issue government bonds at auctions held several times a year, either competitively or non-competitively. When you place a non-competitive bid, you agree to the auction's terms. You can provide your preferred discount rate, discount margin, or yield when submitting a competitive offer. You can keep track of upcoming auctions on the internet. Before we continue with our discussion, please make sure to hit the thumbs up button and feel free to share your thoughts in the comments section down below. Now, let's get back to our discussion. Let's have a look at how to buy bond mutual funds. Bond mutual funds provide many of the advantages of individual bonds while reducing risk. Buying mutual funds is also a much easier process. The benefit of diversification and expert management are two essential features of bond mutual funds, Powers explains. Investors in a bond mutual fund benefit from having fixed income professionals manage their money and being in a pooled fund rather than holding 10 separate bonds. They possess hundreds of bonds, therefore, the chances of one having a disproportionate impact on your results are substantially lower. Bond mutual funds, like stock mutual funds, allow you to pool your money with other investors to buy shares in a bond portfolio. Bond mutual funds can be managed actively or passively, and they usually follow a certain bond type, corporate or municipal. They tend to stick to a specific maturity plan, whether long or short term. The following are some of the advantages of bond mutual funds. Bond mutual funds have the same liquidity as stocks in terms of purchasing and selling shares. Unlike stocks, orders to purchase mutual fund shares are only fulfilled once a day, after the market closes. Dividend reinvestment. Funds make it simple to reinvest your income monthly dividends back into the fund, allowing you to continue expanding your portfolio. Regular income. Most bond funds offer monthly distributions as an alternative to reinvesting dividends, offering a consistent stream of cash for investors who prefer the income benefits of bonds. Investors may choose municipal bond funds that give tax-free income depending on their tax rate and stage of life. Interest paid on municipal bonds is generally excluded from federal income taxes and may also be exempt from state and local taxes. Management fees will be charged to bond mutual funds to pay fund managers for actively managing the bonds purchased and sold inside the fund. This cost is calculated as an expense ratio, which shows the fees you'll pay each year based on your investment. A bond fund with a 1% expense ratio, for example, will cost you $10 per year on a $1,000 investment. Many bond mutual funds have minimum beginning investment requirements, which you should be aware of. Regular brokerage accounts and qualifying accounts such as IRAs have different minimums. Let us now turn our attention to buying bond ETFs. Bond exchange-traded funds, ETFs, are a way to invest in bonds. ETFs are similar to bond mutual funds in that they are made up of baskets of bonds that follow a certain investment strategy. Bond ETFs can be managed passively or actively. Fees for ETFs are often lower than those for bond mutual funds. By and large, ETFs are relatively low cost, and investors may keep more of their profits instead of paying a manager's fee as they would with a mutual fund, Powers adds. The NAV cost of the ETF, rather than the initial investment minimums with many mutual funds, is the threshold of entry for a rookie investor or someone with less money to invest. ETFs provide increased liquidity in addition to lower costs. ETFs trade like stocks throughout regular market hours, whereas mutual funds only trade once a day. Bond ETFs, like bond mutual funds, provide regular income payments. If you're looking for a way to acquire bonds, a bond mutual fund may be a better option for investors who expect to hold the fund shares for a long time. Bond ETFs may appeal to more active investors because many mutual funds levy short-term redemption costs to discourage excessive trading. Overall, purchasing bonds, whether individual bonds, bond mutual funds, or bond ETFs, diversifies and secures your investment portfolio. You must conduct due diligence on any bond-related investments, including researching issuers, comparing bond ratings, and, if possible, consulting with an investing professional to help guide your decisions. And that's it for today's video. If you want more videos like this, please make sure to subscribe to the channel and turn on the notifications to be notified of every new upload. This is Financial and Investment Wisdom, and we will see you in our next video.